Entrepreneurs, angel investing, and venture capital. This is a rapidly expanding and evolving part of our financial markets. For many entrepreneurs, this can seem like a complex and daunting landscape. For investors, navigating a wide array of opportunities can tax even the best resourced operations. In this mini-series, Kevin Monserrat of Consilience Ventures asks, what's next for the venture capital industry? He follows the startup journey, first from the perspective of the entrepreneur, then the angel investor looking for early investment opportunities, and onto the VC funds looking to deploy larger levels of capital. Indeed, many features of the broader capital markets, such as data, analytics, and speed, will become increasingly important in this space. Kevin asks how each group is dealing with issues such as liquidity, sizing within portfolios, equity dilution, and the increasing volume of data. Each guest outlines their own experience of how they got into the business, how they've seen it develop, and what the future holds. Along the way, they provide a wealth of insights for everyone, from experienced practitioners to those who are new to the industry. In this episode, David Tetten, an entrepreneur who became a partner in a tech-enabled VC fund, looks at the evolution of VC funds and how they've been using technology to adapt to and overcome some of the fundamental changes that are appearing within this quickly evolving sector.
Discussion we're going to have about the venture capital and where the venture capital is going, and in particular where the technology will impact venture capital. So before we get started, can you tell us a bit more about who you are?
Sure. I'm based in New York. My father's French, so I have ties to Europe as well. I grew up in California. I'm a serial entrepreneur with 10 years of experience as a venture capitalist and previously 2 exits as a founder. I was a first outside partner at FF Venture Capital, and then formerly a managing partner and first outside partner at Hoff Capital, 2 early stage New York VC firms. I founded Harvard Business School, Alumni Angels of New York, which is now the biggest angel network on the East Coast of the US. And I've been fortunate to have some success in the past. I'm now building on that to launch a new firm, Versatile Venture Capital.
Before we dive in, how do someone like yourself get into the tech stack of the VC? I mean, you started a long time ago, and VCs are known to be dinosaurs, right? They are known not to be the most agile and the most tech-enabled firm, but still, with all of your background, you basically decided to focus on this. So tell us a bit more about that.
Well, I want to do my job as effectively as possible, right? And I think any professional wants to do that. And what I see in the public markets is a clear multi-decade trend towards greater use of technology and analytics. If you look internally at D. Shaw, Two Sigma, other more analytically focused firms, they look very different than Warren Buffett sitting in his office going through a 10K with a pencil. So it's clear to me that there's a lot of room for private equity and VC firms to pursue a similar path and operate more effectively, but many firms are not using all of the technology and data available to them to be better investors. So that's the fundamental insight that drives my interest in the space on 2 levels. As a user, right, it's my job to be an investor and I want to do my job well, but also as an investor, I want to invest in companies that help investors in private markets do their jobs more effectively. And that's led me to investments in companies like Earnest Research and Adipar and Cardify, which are all doing different things to help both public and private market investors.
So when you're launching a fund in the 21st century, what is the strategy that you're pursuing? Where do you think the big opportunities are for tech-enabled VCs?
So Kevin, we're doing 3 things that we think are particularly unusual. First is we're an aggressive user of technology and analytics internally, both to manage the firm and make better investments. We've already built a much more automated back office than most early stage VCs. We've published a detailed roadmap for how we're doing this. Contact me directly or look on my website if you want a link to that. Second is we're launching Founders Next Move, which is a private community for founders in transition. Our thesis there is that founders are a different part of the labor market. They're not like most folks who get an entry-level job and switch to another company after a couple of years and get a higher level job and move up the ladder. Founders are their own creatures, and once you have founded a company, your career options change. You can found another company. You can become an angel investor, assuming you've had some financial success. You can be a VC. You can consult, maybe be a board member, depending on your situation in life. But usually it's harder to just go back and get a traditional corporate job. And so I'm interested in this population because I am one, right? Because some of them I'm going to back in their next company. Some of them I'm going to recruit into my companies. Founders, by definition, are people who get things done, and I want people like that working for our portfolio. We have a whole set of free resources on our website for founders in transition. And then thirdly is I'm very sensitive to where we are in the VC cycle, which is a historically cyclical industry. Valuations by any measure are high, which is great for me for my historic investments, but makes me nervous when deploying new capital. And so I'm particularly focused on capital efficient companies. Those are companies that are sensitive to how they deploy capital, and companies that are off the beaten path. One of the most amazing statistics I've found in researching this is of the Inc. 5000, the 5,000 fastest growing companies in America, only 6.5% raise money from VCs. So that's pretty pathetic of our industry, right? My whole industry is supposed to go out there and find fast growing companies, and our penetration is 6.5%. So that indicates to me there's a lot of room for our industry and for our firm to do a better job in connecting with fast growth companies.
So I guess from there on, I've got tons of questions, David. So the first thing is, where do you think technology is basically the cutting edge of versatile VC? Where does it stop? You've got the community, you've got those tools, but what is it that you think a VC, an early stage VC, should build in order to be more efficient?
I will contrast this with how public markets investors think about technology and analytics. My friends who work at the large technology-driven, analytics-driven hedge funds, most of the calories there are focused on origination. They don't call it origination, they call it trade selection and trade weighting, but it's fundamentally about what investment do I make.
Yep.
And the reason is because in the public markets, almost everything else is highly, highly automated, so there's not really a lot of decision making to do. In the private markets, that's not at all true, right? Once you invest, you still have typically a decade where you're an investor, and there are many things you can do to increase the quality of that investment during that period. So I've mapped out 11 stages of investing, from your sourcing to the actual execution of the investment, to how you work with them on your platform, to how you actually exit. And at every stage, there are ways to use technology to do your job more efficiently. And so I think about it much more holistically than just origination, although I find people tend to default and think, oh, you're mining LinkedIn and looking for patterns of where there are more PhDs starting companies.
Well, you have plenty of funds doing that already, right? You've got a few funds, we're not going to name them, we know them, but they are using machine learning techniques and web scraping techniques to find companies. But my question is we know that most of the job of the VC is to find deals, right? 80% of the job is to find deals, and 20% is to add value to the portfolio and exit, right? Am I being fair?
I would push back on that, because I think that once you find the investment, if you're a material investor, if you have a board seat, and even if you don't, honestly, there's a lot of things you can do to impact the investment. In the public markets, once you put on a trade, what can you do? You can sell and get out. Yeah, you can hedge, you can pray. That's it. And one of the reasons why I like the private markets is there's a lot more you can do.
There's far more you can do, but do the structure, the normal LPA GP structure, allow the VCs and the general partners to spend the time with their companies to have the impact that you mentioned they could have?
Good question. So the firms that I think have really taken this to the next level, for example, Andreessen Horowitz is well known for having a very, very large platform team, which they can afford because they've got a lot of resources. Yep. At my two prior firms, we both had extremely well-resourced platform teams because we viewed it as something that would lower our origination costs, but also improve the odds of success in the company's post-investment. That is a very material upfront investment that we were making, and the LPs were really benefiting from that investment, and most VCs are not in a position to make that large an upfront investment.
Where are the limitations of the technology in a human-centric industry like venture capital?
There are definitely a lot of limitations. So first off, VCs deal with innovative companies, which by definition means they may not fit the analytical criteria that have been relevant in the past. You couldn't have built a model a year ago to assess the value of an NFT of a JPEG of an ape, and now there are people who are trying to do exactly that. Second is there's only low quality data available, which makes modern AI techniques, which are hugely impacted by quality data, very difficult to use. So think of all those transactions, which by definition are private, where unless you are a principal in the situation, which is why the big investors have an advantage in this regard, you actually don't really know how much money people made, what the economics were, and so on. And the most important data of all are the outcomes, right, which are the exits. But exits are actually relatively rare relative to the total number of transactions in the ecosystem. Certainly relative to the number of data points you have about price at which Apple stock trades, right, which happens every minute. And so you don't clearly have a clear outcome variable against which to do a regression. And so those all create challenges. But the current state of the art in the industry is so low, I think there's certainly room to do better than the current state of the art.
Do you think we should be absolutely open, or do you think that opacity and lack of transparency is embedded into our ecosystem and won't go away for a very long time?
It's not going to change because any individual actor has incentive to play up the successes and play down the failures. There are ways to proxy it. So for example, I know someone who scrapes Twitter profiles of VCs, and he looks for when a VC says, I'm an investor in Uber, right? Because he's proud of it, and then he takes it off because he's not proud of it. And that's a pretty good proxy for what companies are doing well or not doing well. You can also look at whom you're linked with on LinkedIn, right? That indicates you're taking meetings with those people. What companies you highlight in your bio on the corporate VC website, both as a portfolio and then the individual bio of the individual partner. Those are all ways to figure out what's really going on at the level of the given company.
What is the difference for you between what makes a good VC and a great VC? Where is the difference in the 21st century? Is it that you have built the best brand, or is it that you are taking something, you're swimming against the tide?
So the best investors in any asset class are the people swimming against the tide. By definition, right, that's the hardest position to be in, because everyone who's swimming with the tide looks great until the tide goes out. So the three things that I would highlight as attributes of the most successful VCs, besides, I should say, the ability to swim against the tide. So one is thoughtful process management, meaning you understand the process, you document the process, and you iteratively improve the process. I don't think you can claim to be good at something unless you can articulate what your process is. Second is reputation. In our industry, past performance is predictive of future results. That is not true in the public markets, and so that certainly matters. And then thirdly is, I would argue that because networks are so much more transparent now, who you know is less important than what you know. 20 years ago, a lot of the sales pitch for VCs was, oh, I can get you a meeting with XYZ. But now you can look on LinkedIn, you can find the right person at Apple. There's still a lot of value in the network in getting that person to pay attention to you. But the ability to find the right person who will resonate with your particular sales pitch is much easier today than it used to be. And so that's why I think it's so important for us as a firm to try and be not just a router, but also a server of information access and other resources.
Do you think LPs are interested in finding unicorn VCs, so VCs that can swim against the tide, or do you think that they are more interested in the traditional VC that have very traditional agreements in an LPA that everybody can read, everybody can understand, so that the limited partners are not forced to learn much because they have to deploy the money. They've got to invest this money into many funds, and for them it's a lot easier to invest with 10 or 20 funds that have almost the same limited partnership agreements versus finding a VC that operates very, very differently and have 10 VCs that operates very, very differently because of the time and energy that it takes to understand the uniqueness of those models.
I 100% agree. And I don't want to bash LPs too much because the LPs are clients of mine. But you know what? I'm going to quote someone who was bashing LPs, which is a great case study. So I have a lot of respect for Indie.vc, which is a very innovative new VC firm. And the founder recently announced that he's shutting down the business model of Indie.vc. And he very explicitly said, because LPs are too conservative. They claim they value diversity, and he was investing in diverse founders, and he reports great numbers, but he was doing things that were very unusual in the VC space, and it created a lot of friction because the LPs had to work harder to understand it. So I'm not an insider there, so I don't know the full story, but those certainly resonate with my own experiences, that it's very easy once you have great returns and you're on your fund 3, everyone wants to give you money. But when you're doing things that are unusual, it's a lot harder to raise capital for a fund, and that's the nature of the market.
So what do you think we can do to educate the LPs, or to actually simplify the lives of the LPs, for them to be able to effectively entice more innovation in this part of the market to the benefits of the founders? Because there is something that is quite unique about the place of a GP or an investor in general, is that you can only be as successful as the companies that you back, but your clients, as you said, are the limited partners.
So first off, I think you should be creative where you need to be creative, and as conservative as possible in other respects. So for our firm, we're doing some unusual things, but most of the aspects of the firm, for example, legal structure, are very plain vanilla, because they don't want to create extra friction in engaging with other players in the ecosystem. Second is, our industry is certainly much more transparent than most other industries, and that makes it easier to educate lawyers, accountants, the LPs, other ecosystem participants in new trends. So, for example, NDVC outsourced their term sheet, right, in an effort to make it easier for people to understand. So that's a good practice. Thirdly, there's certain LPs who more publicly indicate their interest in emerging managers. I track those on my website at Teten.com. And so those are the ones that I think VCs that are doing innovative things should specifically be talking with, and they're hopefully more likely to get a positive reception.
But if you build a picture of of the next 20 years of the VC market, do you think that it's going to be more transparent, a lot more transparent, and then more liquid? Or do you think, because I think transparency is going to come with liquidity, that we can have a whole video around this, but the more trust you have, the more likely you are to create the liquidity, right? Because if only a very few people can know the truth, then of course you're very unlikely to create that level of liquidity and that virtuous circle of liquidity. So where are your thoughts on that?
So you're bringing up a lot of separate issues. First off, I will highlight one other critical reason why you see this movement towards transparency, which is COVID. Right now that so much of our business life is virtual, you assess trust in a different way than the traditional way of checking out how nice is your suit, how fine is your watch, how's your body language and your handshake. You could easily argue those are all really stupid ways to assess someone, but that is true, right? That is historically a big part of how people assess, are you a trustworthy person with whom I will consider doing business? Now that it's all virtual, how do we assess a stranger that we meet online who we're considering giving millions of dollars to? We Google them, right? And what you see on Google really, really matters. And that's one of the reasons why I've invested energy in publicly documenting our processes at Teten.com and on our corporate website, because I want to make it easier for people to assess me who will likely not meet me in person, right, because of the current environment. And even when hopefully COVID becomes as accepted as the flu, people are not going to travel for business the way they used to. So to your point about liquidity, so I certainly agree with you if people have more data about the companies that will enhance liquidity, but it's really striking to me how many millions of dollars are being thrown around into SPVs when people don't actually have a clue what's going on in the company into which they're investing.
It's unbelievable. It
Right.
is unbelievable the number of SPVs we see where investors are putting money into SPVs without really looking at the terms of the SPVs. And sometimes they are very, very nasty terms on SPVs. And as you said, millions of dollars are flowing into through SPVs because it's just an easy way to deploy capital. But I suspect that we are sitting on a small time bomb because there are terms that are very, very nasty for the investors via SPVs who do not take care of that properly.
Yeah, not just the terms, but the underlying company,
It's
right?
even worse.
Where you just don't know. Do they have any chance of making a profit? I don't know. Here's 10 million bucks, right? So that's what's happening. That all said, that's probably because, of course, we're in an up market. And in general, if the company is willing to be transparent, and there certainly are some companies I know that are unusually transparent in compensation level. There's some firms that say publicly the comp level of everyone in the firm, in their internal metrics, right? If the company is willing to do that, great. That's not my decision. The company has to own that decision about how transparent they want to be, and there are a few such companies doing it.
What do you disagree the most about the VC market?
Well, I know a lot of people, including me, who made a lot of money in VC in the last decade because it's been an up market. And so there's a natural tendency to confuse brains with a bull market. But quoting Keynes, the market can remain irrational longer than you can remain solvent. So I think that people don't have as good an appreciation as I think they should of due diligence, of analytics, because in hindsight, who needed DD, right? Like the best strategy for the last decade was just shovel out as much money as you possibly could. That is definitely not the long-term investment strategy of smart people. And so I think that people will have an even greater appreciation than they do now when the market inevitably turns. And so I'm trying to prepare for that inevitable turning.
My last question is about access to venture capital as an asset class. It is very, very elitist. It is very difficult to get into the VC market. Most people don't know even about VCs before entering into VCs. I didn't know anything about it. So how do we help people to understand the benefits of the venture capital market, and and how do we educate them about investing into VCs? And do you think it's even a good thing?
Well, I think the transparency certainly helps with educating potential investors about VC. There's certainly firms out there, for example, I'm an investor in Republic.co, which have made it much easier for retail investors to invest into VC funds and to private companies in general. And so that lowers the bar. I don't think that it should be completely open so that anyone can shovel money into any company, because that sounds a heck of a lot like gambling. And in most countries, there are regulations on gambling for good reason, right? People get addicted to gambling and can destroy their families and their savings. So it's appropriate that there's some level of regulation around investing in order to protect the participants and also protect the industry, right? Even though I believe I'm a good actor, right? There are always bad actors in the industry, and they will take advantage of the dumb money, and that will hurt the whole industry. So you want some regulation to keep up.
Do you think that if everybody could invest, or if most people can now access to VC, that will pump more money into the market? And we saw what it does on on the public market, especially on the GAFA right now. Everybody can invest via Robinhood or any other kind of fintech apps that have effectively risen for past 5-6 years. That will impact the value of the asset, and that will impact the value of the underlying value of the VC NAV, right? Because you will have more if you have done a fund before we pump so much money, and you've deployed your fund before the valuations go crazy, then you're doing well. But as you said earlier, the more money you have flowing into this market, the higher the valuation. And will this make most VCs viable businesses, given that what makes a VC successful is the price at which you buy and the price at which you sell?
So I would submit that if you have people who are in the industry who are investing, you're expanding the pie. So if someone invests 5K into a VC fund because they're modest net worth, but they're into the industry, and then they're investor my firm theoretically, and they call me and they say, hey, I mean, we wouldn't work such low checks, but set that aside. The point is, if they're involved with a VC fund, they will refer opportunities to them, and they'll be able to explicitly say, I work with that guy at Microsoft. He's really great. I want to back him. Maybe I personally don't have $1 million to invest in, but you should give him $1 million, and here's why. So that actually helps because you grow the pie. The level of entrepreneurship in the US is, contrary to popular belief, actually lower than in a lot of European countries. And there's a lot of room to grow the total population of entrepreneurs, which is good for the economy, good for the participants, and good for the VCs. So this goes back to what I was saying earlier about contrasting the public markets. One of the things I like about the private markets is it's not a zero-sum game, neither in the opportunity set nor in the companies once you've actually started to invest in them, right? Because you can grow the company and all the participants will benefit. Whereas in the public markets, every time I sell, someone else buys, right? It's basically zero-sum.
Do you think that the next VCs will be technology companies, or do you think that they will remain VCs with great network and great access to potential buyers?
So I think every company is going to be a tech company, including VCs. In fact, that's one of the core beliefs of our new firm, right? So look at Casper. That's a mattress company, but somehow they're valued more like a tech company. I'm not an investor, but that's just an extreme example of a company that rethought what they're doing from the point of view, how do we use technology to do it more effectively? So yes, VCs are going to be tech companies that have to adopt that framework, and that's how you're going to win.
It was a great pleasure, David. Thank you so much for joining us in the show, and I look forward to talking to you again.
Thank you for your time. Take care.